Welcome everyone to This Explainer. Today, we have one singular goal: building the exact blueprint you need to secure that A-star in your IGCSE accounting exam. We are focusing strictly on the ultra-dense Module 07, balancing accounts and transfers, and we're looking at this exclusively through the lens of the syllabus 2028 to 2030 updates. So consider this your high-level masterclass in mastering the exact logic that secures those top marks.
Here is our A-star blueprint for today. Number 1, core concepts and terminology. Number 2, flawless step-by-step execution. Number 3, mastering AO3 ratio evaluation. And we'll wrap up with number 4, an advanced examiner strategy guide. Let's get straight into it.
Section 1. Core concepts and terminology.
Listen up, because I need to issue a strict examiner warning right out of the gate. For the syllabus 2028 to 2030 updates, Cambridge is operating on a zero-tolerance policy for outdated vocabulary. Seriously, if you write bad debts instead of irrecoverable debts, or if you forget to use the term owner's equity, you are going to lose marks. Accuracy here is totally non-negotiable for top-tier students. You really have to speak the precise, modern language of international accounting.
And you know, that precision stems directly from the foundational accounting equation: assets equal liabilities plus equity. To really grasp the duality of this, think of a modern industry application, like cloud computing synchronization. If a primary server updates financial data in London, a backup server in Tokyo must perfectly mirror that data instantly, right? Well, in accounting, every single transaction must have an equal and opposite entry to maintain that exact structural balance. There's no getting around it. Maintaining that precise balance means practically applying principles like accrued, prepaid, realization, and consistency. Let's be clear, these aren't just vocabulary words you memorize for a quick multiple-choice question. In a complex multi-step exam scenario, say a business prepays its rent. Well, you must actively adjust that out of the current year's expenses to maintain the consistency of your reporting. This is exactly where the theory has to meet practical application. Which brings us to a direct examiner insight. Students often overstate profits by ignoring potential losses, which is a violation of the prudence principle. If you ignore those potential losses, you artificially inflate your assets, and what happens then? That completely destroys a business's real-world transparency. You're potentially tricking tax authorities or even tricking banks into issuing loans based on a falsely optimistic reality. Prudence isn't just some rule, it's literally the foundation of financial integrity.
Moving right along to Section 2, flawless step-by-step execution. In your coursework and practical exams, there is a very strict procedural logic you must follow. Step 1 is identifying the business document. That smoothly flows into Step 2, the books of prime entry. Step 3 is your T-account ledger, and finally, Step 4 lands you at the final financial statements. As an examiner, I have to tell you, a massive area where students drop marks is trying to leapfrog from the business document straight to the T-account. You must document your evidence and respect that prime entry stage. Skipping steps just causes tiny data errors to snowball disastrously.
Now, Step 3, the T-account. That's where the double entry magic really happens. But under immense exam pressure, students frequently mix up balance C/D and balance B/D. So here's a quick memory hack to lock this down forever. C/D stands for the closing door of the current month. B/D stands for the beginning dawn of the next month. Close the door to finish the period, begin the dawn to start the new one. Use that little trick to keep your bearings when the clock is ticking. Let me issue another warning, this time regarding trade versus cash discounts. A major mathematical pitfall we constantly see is calculating the cash discount on the gross amount before applying the trade discount. Always apply the trade discount at the point of sale first, then calculate the cash discount on the remaining balance at the point of payment. Getting that sequence wrong ruins the entire ledger, particularly when you're navigating those really complex manufacturing accounts.
Ultimately, your goal in the trial balance phase is 100% accuracy, because 99% accuracy is 100% failure in double entry. Achieving a perfect trial balance proves your mechanics are totally sound, and it guarantees a seamless transition into those final financial statements.
All right, let's jump into Section 3, mastering AO3 ratio evaluation.
Assessment Objective 3 is all about high-level investigative and practical evaluation skills. Let's look at a symptom. Say a current ratio plummets from 2.5 to 1 down to 1.1 to 1. An average student simply notes the drop. But an A-star student, they rapid-fire the potential causes. Did they overpurchase inventory?
Are trade payables grinding to a halt? Or do they drain their cash reserves on some massive capital expenditure? You must actively debate the cause and effect chain and investigate the real-world decisions behind the math.
And this evaluation becomes even harder when you're comparing different firms. Comparing a business using the straight-line depreciation method to one using the reducing balance method, well, it's honestly like comparing a marathon runner to a sprinter. They are fundamentally pacing their expense recognition in totally different ways. It makes direct apples-to-apples comparisons incredibly difficult. And that forces top students to really dig deep and investigate the true underlying quality of those reported profits.
Furthermore, true A-star AO3 evaluation requires looking completely outside the ledger at non-financial factors. We're talking about things like staff morale, location, and overall market reputation. None of those factors sit neatly in a T account, do they? But they absolutely dictate a company's long-term sustainability, and they heavily influence the future return on capital employed.
And finally, Section 4, our Advanced Examiner Strategy Guide.
Let's talk about our advanced technical methodology, specifically the method mark strategy. Listen closely. In the exam room, you must show absolutely all your workings. If you make a calculator error on depreciation, yeah, your final mathematical balance is wrong. But if you clearly show the examiner your logical flow and the specific adjustments you made, you will secure method marks, and that can literally save your entire grade.
Another critical area is accurately separating revenue items from capital items. Let's use a highly memorable analogy for this. Revenue expenditure is like buying the printer ink to survive the week. Capital expenditure is buying the industrial printing press to survive the decade. Treating that massive capital press as a day-to-day revenue expense will instantly derail your ledger. It's going to artificially tank your profit and totally ruin your final statements. You have got to keep the ink and the presses strictly separated.
To wrap up this academic masterclass, I want to leave you with a pause and think A-star challenge. If a business aggressively cuts capital expenditure to artificially boost its short-term cash reserves, how does this tension between immediate liquidity and long-term ROCE challenge the prudence concept? Take some time to independently connect those dots between liquidity, long-term strategy, and the strict rules of transparency we cover today. Thank you so much for joining me for this explainer, and keep mastering those accounts.